Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to the Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom today are my co-hosts, Missie Beach and Michaela Laney.
Hey, Casey.
I can say that really fast.
Yeah.
How you guys doing?
Great. How are you?
You're back for episode 2 together.
Yeah.
This is
Have we
3.
done this? Oh, this is the third time we've done this?
Yes.
I forgot. This is episode
call.
171. So, I kind of forget about these after a while. Everyone probably knows this, but Missy's a senior financial planner with us. Michaela's a planning associate with us. Yes. And they do a bulk, if not almost all the financial planning that comes through Wiser right now. You guys are kicking it. We've got backup coming. We have William
Waiting in the wings.
Waiting in the wings. All right. So today we're going to talk about I've inherited money. Now what? So we have to start. We have to start with the first thing that any client asks us when they come in and they've inherited money, which is how much tax do I have to pay?
Yeah.
So Missy, why don't you break that down for us?
Okay. Well, when you inherit money, the good thing is inheritance taxes don't apply to you, the beneficiary of the inheritance, unless you're in some obscure state outside of the Southeast that does impose an inheritance tax.
So no tax paid by the person inheriting assets. Now, as far as the estate paying tax, federal tax.
Well, if your estate is worth, 24, 25 million.
For a married couple.
Then the estate might owe tax. But the estate tax rate is actually going to come down in 2025 to maybe $6 million or so
per person.
So then we're down to the $12 million per couple taxable estate. So still, it's up there. We might have some clients running into that, but not for the general population. Is that ever really an issue?
Right.
So for our clients coming in, saying to us, hey, I just inherited, a couple $100,000 from my great aunt or from my grandmother, or from my dad, not a problem with estate taxes.
So not a problem because there is no tax. But I'll add one caveat to that. Annuities. I hate annuities, but they are the worst things to inherit.
Yes, they are, because you're always going to have a gain, above the cost basis of the annuity.
Right.
You just can't get around that. It's not like a regular brokerage account that would get a step up in basis.
That's right.
When the owner dies.
So let's explain that. So if I pass away and I leave my children a brokerage account, not a 401k, not an IRA, brokerage account, and I paid $10 for Apple stock, I was a genius. Now it's worth $300 a share, right? The $290 gain goes away.
Your kids could then sell it today for $300 a share, pay no gain.
Correct.
Just pocket that $300.
If it goes to $400 from the date after the date that I died, it was $300. Then it goes to $400. They'd only pay the gain on the $100, not the $10 that I paid for it. You have a step up in basis.
Correct.
Which is why in older client accounts who have individual stocks, we don't really try to liquidate those if we don't need to, because
we know
statistically we should be able to pass those to the next generation with no tax issues. Now, if you inherit an annuity, you don't have that protection. And so what happens is you have to pay income tax, not capital gains tax,
Real tax.
but real tax on the gains in the annuity. In the meantime, the person who bought it, who left you this annuity, was told they were the very most tax efficient vehicle ever, and they were lied to.
Yeah.
So again, stay away from annuities. Another way that income tax could come in is inherited IRAs.
Yeah. I mean, if you're a spouse, you can take over that IRA into your own IRA.
No tax issues.
No tax issues, and, take it out over your lifetime. But if you're a non-spouse, say you inherit the IRA from your mom or dad when he or she passes, here's the bad news. Now you have to empty that IRA over 10 years. So if it's a big IRA balance like we're seeing these days, $1 million IRA over 10 years, it's adding $100,000 of taxable income.
Plus the growth.
Yeah. So an IRA is not a great asset to pass on.
But there's not much you can do about it right now.
Yeah, it just is what it is, unless you're doing Roth conversions during your lifetime to try to, whittle it down and get it out at a lower tax rate than what your kids are in. But it just kind of is what it is. It's life.
That's where it comes down to legacy planning. If your kids are super successful, making either in the 37% bracket and you're still in the 22, it might still make sense for you to convert at the 22% rate because their income tax is it'll be taxed higher. So the money lasts longer. The family gets more money. But if you're in the 22 or you're in the 12% bracket, your kids are in the 12% bracket, or they're in the 22 and you're in the 22, to me, it doesn't make a whole lot of sense to accelerate that unless it's just truly, excess funds.
Yeah.
So it takes a lot of planning. There's no way we can give advice to the masses on how to handle that. It's situation by situation. And then obviously sometimes we see, a scenario where one child is in the 37% bracket and the other one's being supported by everyone else in the family. So then you have, that's where you have to get into more doing some trust work.
Exactly. I've even had one client couple in the past who were in a low tax bracket, like 22%, and both kids were in the 39.6 at that time, the highest tax bracket. And so what they did is they would gift the parents up to the annual exclusion every year to help the parents with the Roth conversion, knowing that they were ultimately going to inherit the IRAs. So they wanted to just pay the tax burden
at their rate,
at the parents' tax rate, knowing they were going to get the IRAs one day, but they wanted the tax at the parents' tax rate. The parents didn't need the money out of the RMDs anyway, so it didn't matter. It was just extra. So the kids facilitated the Roth conversions through annual gifting, and it all worked out.
That's good.
It's a great strategy.
So again, that's an individualized strategy. It's hard to figure this out for the masses, but
it really is.
So if we understand now, like the tax implications,
right?
After that, you've inherited. Let's assume it's essentially cash, or it's very liquid. What do you do now?
I think the biggest thing is you steward it well. I think it's one of those things where it can be very easy to be like, oh, I got all this money, I'm rich now, or whatever it is that you may think. And I think that's, but it's also a really hard time as well, because you're having to grieve the loss of a loved one, and that can jade our vision in so many areas of life. And we know that the things that people are not necessarily the most rational about are money and the people that we love. And the grieving process is not a rational process at all. And so having all of those commingle together during that time can be a very high anxiety point for families. And so it's really sitting down and figuring out the best avenue for yourself. So like you had mentioned earlier, paying off the mortgage, if you have a large mortgage or something like that, to putting your money or the money that you've been gifted to good use. That's going to be the best for the overall financial picture. And just really analyzing yourself and making sure it's not necessarily, oh, let's go on that $20,000 vacation to Europe. It's no, because at the end of the day, an inheritance can make you rich for a year or it can make you wealthy for a lifetime. And it's really all about how you're going to choose to steward it. And if you're going to steward it well and you're going to use it as a loving legacy and a blessing that they've gifted you, or you're going to use it as a, ooh, let me get out of jail free card and let me go live life lavish for a year. And so it's really down to those principles and how you choose to make that decision.
We met with a family a few years ago that the daughter was working really hard on managing that inheritance well. And she mentioned other family members that might want to come see us. And then she says, but my brother won't. And I said, what do you mean? He booked private jets almost everywhere. They went on vacation for about 3 years. And now their money's all gone.
Oh my goodness.
Yeah. Choices.
Yeah. And it was a decent sum of money. So I could see why he probably had a false sense of security, but then eventually you just run
3
out of,
years later.
you run out of dollars. Yeah.
Well, it's like you're the winning the lottery people that you hear that,
like
they win the lottery, they have multiple of millions, and then
it's like
it's
90%,
gone.
isn't it? Don't
Yes.
90% end up in bankruptcy. I don't know
think
where
so.
that starts. I don't know if that's everyone who wins the lottery. Cause you could win the $10,000 lottery and still,
Oh, yeah.
I don't know if they
threshold.
count that stat or not, but
Yeah.
I know the big ones. There was a whole TV show about it. I never watched it, but there's a whole TV show about that. Would they
That'd
win?
be fascinating. Yeah.
Yeah.
The psychology behind it. But I think, Michaela, you brought up a big point in that, an inheritance is not something that we plan for at Wiser. A lot of times clients will say, oh, and I forgot to tell you, there'll be an inheritance one day. And we always say, oh, well, that is great. Thanks for letting us know. But we always plan on just known facts. And so we'll have that out there as a maybe, but, your grandmother, I always joke, might go to the casino and put it all on red and it's gone. Or she might be in the nursing home for the next 10 years and totally bleed it down. Mm-hmm. So while there's good intentions that you think you might get this money, who knows what happens over the next decade or two. And while it seems like, you're going to get an inheritance, who knows? So we don't even put a placeholder in the plan really for it.
Yeah. And that's the right way to do it because it's not guaranteed unless it's sitting in a trust separate from their assets. I think that's the only time I've ever counted it in any plan that I've touched was the money had already been segregated. It just doesn't transfer to them until their death.
Yeah. And another thing about an inheritance is that a lot of people are reluctant to move it out of the actual form that they got it in. So say their grandmother left them $500,000 in Coke shares. They feel really emotionally tied to Coke shares because Granny bought them back in the 50s. And sometimes it's really hard to explain to them, like, this is a wonderful gift from your grandmother. You have to look at it in the big picture terms, not the fact that it's $500,000 of Coke shares. Take Coke out of the picture. Think about the legacy and not the format, because that's usually all the client may have, or it's the bulk of their net worth. And this is the prime time to diversify and spread out your risk from just that one single company, because the basis got stepped up at Granny's death.
Right.
So now we can put them into a diversified portfolio and spread out that risk. And so I feel like a lot of times I'm trying to beg clients and show them the value of it's her legacy, not
especially
the format.
With the step of a basis.
Yeah.
Yeah. Very true. We have a whole series that we did on legacy planning. And I think it was Mr. Hughes. He wrote a book. I can't remember the title of the book, but you can search for that in our archives on our planning, or we can link to that in our show notes with that. And it's telling a story And, if in your example, Granny had done a great job of saying, hey, I bought these shares. This is why I bought those, that they appreciated. Coke in her time is very different than Coke in our time, right? And so you understand the legacy and the story behind it. There's ways to modernize that portfolio to be what it should be for today and building for the future.
Well, it's also like individual stocks. A lot of times when they were investing in them was like the way to invest.
That was the only.
That's true. There
that was
were
the only
no
way.
ETFs.
There were no mutual funds prior to 1980,
Exactly.
or very few compared to
if
today.
they've had them for however long, then that was the best option at that time, and they've held it and held on to it, and now there's a better option.
You're right. I'm sure Granny would have chosen ETFs
Yes.
if given the opportunity.
Specifically the S&P 500 instead of one
Absolutely.
individual stock. But yes. Yeah. So I think that's an important thing is you have a reset, and it's thinking, okay, what do I want to do with that? And it's amazing. I think we've had more families recently, at least the ones that I've been working with, that have been focused on, okay, I inherited this. I want to be a good steward, but I'm never going to touch it. It's just going to go on to the next generation, which is very interesting. I haven't seen that as much in the past, but it is really how you pass on generational wealth.
Definitely.
But again, that goes back into more of a legacy conversation. I want to focus today more on the people who are receiving an inheritance. But I do think it's a great opportunity to right the ship.
Yes.
What I hate seeing is on the smaller inheritances, let's say less than 500,000. Then they pay off debts, maybe pay down or off a house. But then you meet with them 2-3 years later and they're right back into the debt again. So you have to make sure, you have to understand you really have to look from the outside. So for me as an advisor looking from the outside, sometimes I tried to hide the money from them and they don't even realize it.
I like that.
But I was like, let's pay off the house. And then you take that money that you're paying toward the mortgage, and then you can pay off your credit card debts with that.
Yep.
That way your mom or your dad paid off your home. And that's how you can think about it. Because it's a lot harder to go get a HELOC when you're making bad money choices.
Right, exactly. Right. And get that money back
The bank
out.
will see that too and go, yeah, no, we're not going to keep that one. So you try to hide it from them. And at the same time, it's investing in real estate. It wasn't spent. It was invested in real estate. But obviously, if you think that you can change your lifestyle, then paying off the credit card debts, the car, and then creating emergency funds, doing all the normal steps that we talk about, right? Limiting debt, have an emergency fund, save enough for retirement, get debt paid off prior to retirement, meaning the house, right? College.
Yeah, good lump sum into the 529s.
Yep. Right.
That's a good one.
And then the balance can go into what we call opportunity money, which is our favorite money to manage, because that may not be in stocks and bonds long term. It may be transitioned into a second home or a third home or whatever it is. That's why we call it the opportunity fund, right?
Yes.
But ultimately, I think that you've got to look at the total picture and figure out what's the maximum impact to do with inheritance.
Definitely.
Yeah, I really think paying down the mortgage or paying off the mortgage is a really good one, because that helps clients see that gift from the family member that left it for them. I mean, that's a really tangible thing to do with it.
Right.
And I love what you said. Like, it's really a challenge to go get a HELOC now to start pulling the money back out. So they'd have to jump through some pretty big hoops to, start borrowing against the house again. So that does lock up that asset and keep that preserved for them.
Right. But yeah, it's an individual case by case basis. We can just tell you what I think most questions are, which is it relates to, is this taxable? And then how should I best use this? But I agree with the clouded judgment part. A lot of people say, well, think about doing this with it. And then you're looking at the situation going, that's crazy. Why would you do that? Let's back it up and let's go through these steps to figure out how to make sure you guys are in the best position going forward.
Yeah. I would say the number one question we get asked is, should I buy a rental property?
Oh.
And I'm like, do you want to be a landlord? And they're
Right.
like, no.
No.
I'm like,
Exactly.
even if you're dealing with a real estate management company,
Yeah.
no, that's just no. Healthy long-term asset classes.
Well, I agree with that. You have to have some liquidity, but I do like the idea of having vacation property that is also inside a rental program. I'm still pro that.
Oh, yeah. If it's a vacation.
But you have to have
versus-
you don't want to be the slumlord. That doesn't exist anymore, by the way. There are some flips that people get because they have real estate agents looking for them, but that world doesn't exist right now in a profitable manner. But again, before you have a real estate property like that, there are risks in carrying that. So you have to make sure that everything else is on track for sure. But you think about that. You take an inheritance, you eliminate most of your debt. You now have more free cash flow, which you then max out a 401k plan. You max out deferred comp if that's available to you. You put more money in for your future self. You've accelerated the savings rate. So theoretically, you should be better off, and then your next generation should be that much better off because of that. It doesn't end up that way though. It disappears because why is that? It's because value systems are not passed down to the next generation on how to handle wealth and how to think about legacy in the future.
Well, that goes back to this new concept of like a love letter or a legacy letter that a lot of people are starting to do along with their wills that tells the beneficiary how you want them to live their life and how this money should help them or guide them and what the family principles are, how they should, use it in their legacy and carry on. So that's something for people to consider. Instead of just giving out all this money upon your passing, feel free to write a personal letter and include it to your beneficiaries and let them know how you feel about how they should live their lives and what they should do to be a good steward of your money.
Definitely. And I think it's also so important to have that letter, especially if you have, and you're passing down to siblings that don't come from the same financial background, as far as, you have the one child that's uber successful, has a great financial picture and great financial stability, and you have another that doesn't necessarily have that same positive outlook at that point. And if you know that there's that disparity, having in that letter that you chose it based upon equality, not equity, is so important. Yeah. Because it is something that whether you're the older one or not older, but the more well-off one, or you're the one that, is still, trying to get that next big break, that can be such a level of resentment for your children if you don't take that into consideration. And that doesn't mean give more to the other child or anything like that. But a lot of times it is. You have 3 siblings, then we're going to divide this into thirds. Right. Make it simple and all of that. And so even if you are receiving the inheritance, understanding that your parents didn't choose it based upon equity, or whoever didn't choose it likely based upon equity, they chose it based upon equality. And so just making sure that you have that understanding, looking at it, as well as whether you're someone preparing an inheritance or someone receiving one, to just not let that resentment be harbored. And really, because that can so easily divide a family.
Yeah. I think it's also too bringing in children earlier. But I don't know. I've been doing this for almost 24 years now, and I have seen some crazy, crazy things. I literally had a client that I respected so much. And she was so easy to work for, somewhat of a mentor to me over the years, because I kind of came up with her as her advisor from nearly the beginning. Wow. And I remember one of her children sitting at my office, or sitting in our conference room, going, "Well, I need you to talk to mother because I'm older than the others and I'm not as in good physical shape, and I think I deserve my inheritance now." And I was like,
"Oh."
You know, and so unfortunately for the last 5 years of her life, that was my role. It was just protecting her assets.
Yeah, fending off
from family members. And she eventually passed away. And then the family has, you know, I wouldn't say they squandered it necessarily. One child probably has. They even fired us as an advisor because I kept telling them the truth.
Yeah, well,
Yeah.
You know, I was like,
Truth
no,
hurts.
you don't need to buy a beach rental, beach property.
yeah, because it wasn't a good fit for
Yeah, you
their
have multiple
profile.
bankruptcies. You have multiple bankruptcies in your past. This is what needs to happen with assets. This is how you need to live on this. You can. I wasn't even trying to get them to leave anything to their children. I was just trying to get them
To make it through.
to make it through the next 10 years without having to work. And it's really sad because, you know, that's our job as advisors is to tell them. Is to tell the clients this is the truth, and you try to do that with love, and but it's a terrible situation. In my mind, you know, imagine this. Okay, so right now we sit in a situation where we have 6-7% 30-year loans. So if you're a super successful family, this is now I'm talking to our clients and listeners who are in the ultra high net worth category. So you have. You could probably do it with 10 million in liquid assets, but let's really push the limit. Let's say we have 30 million in liquid assets, right? You have the ability for, assuming your lifestyle is within check. It's a nice lifestyle to the outsiders, obviously, but you always have a friend has more, right? But ultimately, you have the opportunity to create a family bank for generations. You think about how this, like how the Rockefellers and the Kennedys and all these big household names did this. But if you have enough, you're going to inherit, you know, you're passing down assets to the next generation. If that next generation understands the theme and they could take those assets and put it into like a pool. So let's say you have 3 children and they each own a third of this new entity. A trust is probably how you would do it. Grandchildren, great-grandchildren, they can borrow money from the entity. You know what it is right now? 7%. So it's 3.7% is what the IRS deems as a non-family loan. I mean, you don't have to worry about gift tax or any of that, right? So you could go to the family and say, hey, we want to buy a house. We're going to mortgage this through our own family money. It's going to be at 3.7%, right? Think about the savings that you would have as a family. And this really didn't apply as much for the last decade and a half. Yeah,
with such low rates. But
now there's a real advantage to doing that. Home is a secured investment. There's also avenues, and this is why I said it has to be 30 million or more, because 10 million, you wouldn't want to take this risk. But I want to start a company. This is my business plan. This is what I want to do. And basically you're able to go to that family fund, family votes. And basically you're able to then get seed capital to really maybe build something bigger even for the next generation. So there's just so many opportunities that you have to build wealth and legacy. And it all starts with a story. It all starts with, this is what my great grandfather did. This is how he built this company. This is how we as a family are going to think about money going forward. But you can replicate that on a smaller scale for everyday Americans, right?
Yeah, that's neat.
Anything else to add, guys? Gals?
I don't think so.
All right. Thanks for hopping on 2 podcasts with me. I appreciate that.
No problem.
You guys are hard workers. Have high reviews by all the clients. So appreciate all your hard work and dedication to pushing a fiduciary fee only model going forward.
Love to be here.
We have a video about this on our YouTube channel. Does inheritance count as income? It's called A Wiser Retirement on YouTube. Take a look at that. Also, episode 127, the cost of inheriting wealth, estate tax, and opportunities to avoid it. Talk about this a little bit there as well. And then we have another episode about legacy planning we'll throw in to our show notes as well. Thanks for listening to today's episode. If you're interested in learning more about us here at Wiser Wealth Management or want to schedule a consultation, to meet with one of our fiduciary advisors, you can do so by going to wiserinvestor.com, or you can always click on the episode notes. I think that's it. See you guys next week.
See ya.
All right. See ya.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.